Hello, everyone. Welcome to Money Hour Radio, a show where we try to help you grow your money, cut your taxes, and have a very beautiful retirement. I am one of your co-hosts, Ben Barzideh. I have my trusted, esteemed co-host, Matt Nadeau here.
Hey, everybody.
We are both founding partners and wealth managers at Barzideh and Nadeau Wealth Management, a comprehensive financial planning firm located right here in Barrington. And we are fiduciaries. And as an independent, family-owned firm, we truly have the freedom to focus solely on your interests, not some corporations or those shady private equity companies buying everything up these days.
Of course. And as always, we just want to take a moment and say hi to all of our clients who are listening today. We've got some interesting information for you guys when you're listening. You may already know this, but just keep listening, other than us saying hi, because we love you. And of course, we appreciate the trust you place in us. And as I was just teeing up, Ben, we always talk about things going on in the economy, the markets. We talk about financial planning, but this is a little different. We kind of have a special announcement. You listening audience out there know we use different buy and sell signals, the way we manage money. Well, guess what, Ben? We're completely out of the market.
We are DEFCON 1 right now.
And this is not normal. If you've been listening over the past year, we've been bullish most of the time. But when the data changes, we change our opinions. We have signals that help drive this. We're going to talk about what happened, what this means. And then later in the show, we do want to talk about a good financial planning opportunity with these enhanced Roth conversion situations that we may see for 2026 and in the next few years, specifically because of some of the changes with the One Big Beautiful Bill. Definitely do not want to miss that.
No doubt. And many of you are probably listening on the radio right now, obviously. Did you know we also have a YouTube channel where you can see this week's recording along with the previous ones? Go to moneyhourradio.com and then like and subscribe to our YouTube channel. Also, please subscribe to our weekly economic newsletter. It's so good. It's called the 5-Minute Market Brief. It talks about what we're seeing, what we're doing, our analysis of the market. And while you're on BN Wealth, hey, follow us on our social media pages too, Facebook and Instagram. All right, Matt, let's get into our topic. We are completely out of the market.
All right.
Right?
Like we said, boy, this is big news. For our listening audience out there, we like to keep you informed of what's going on in the market, what's going on in the economy. Obviously, we know there's been volatility and turmoil. And I'm not saying that this is a bear market that we're embarking on. We don't know yet. But we got completely out of the market. And when the bell rang Friday of last week, closed out, we evaluated all of our data and our signals, and everything went negative. And so we completely sold out early Monday morning after the market opened up. And if you remember back on Monday, the market opened with a huge gain. So the good news is the timing couldn't have worked out better. Now, I wish it was always that perfect, but when you get a win, you take it. And it was wonderful because we sold out while stocks were experiencing a gain. And once we did that, what we did is we got out of stocks and we moved into bonds, and mostly short-term, high-quality treasuries. And really the focus is on quality and minimizing a lot of interest rate risk. And initially, if we go back before Monday of this week, we had already started selling a portion of our stocks on Thursday of the previous week. And of course, we mentioned that on our air, on last week's show. And then the rest, like we just said, the rest of our portfolio invested in stocks were just sold out Monday morning. And the beauty of it is it really has saved our clients a good amount of money that would have otherwise been lost in this very volatile week in the market.
No doubt. Now, there have certainly been some new developments that has caused us to become increasingly more concerned about the near-term direction of the market. And while things can certainly change for the better, of course, and if that happens, we will quickly start buying back into the market. But as of right now, it's too soon to tell if things are going to be improving quickly or not. And that is why we actively monitor our investment positions every single day. Therefore, we can quickly react to economic and market conditions. And this war in the Middle East certainly is causing an increasingly narrow and complicated path for the Fed as it's pushing up inflation metrics. That makes the Fed very nervous right now.
Yeah, and that's adding to this volatility is right now, most view this current policy rate as mildly or moderately restrictive and just about this theoretical neutral rate. But the problem is, obviously, with the war, there's been a surge in oil prices. And this has started lasting materially longer than initially anticipated. And so what's happening is building up these inflation risks and pretty quickly. And that's a problem given the objectively fragile market and economic environment we're currently facing, with signs of cracks in consumer spending. And also, we've had a mixed labor market that's really been since December. And the Fed has noted that the inflation expectations remain well anchored. And to be fair, they're probably not wrong. But some market based inflation expectation readings are starting to quietly rise.
And in the more likely event that inflation pressures continue to build, and then economic data shows signs of weakness, or worst of all, both. If both of those happen simultaneously, now we're looking at stagflation. And the Fed would, if they have their choice, would logically err on the side of caution and hike rates at the expense of the economy, and all but certainly tipping growth negative and initiating a recession. And many of you not know this, but the Fed, they have no problem tanking the economy and the market if they have to in order to keep inflation at bay. Inflation is enemy number one for the Fed. They've caused so many recessions before. They have no problem with that. Inflation, it looks
always
really
the
bad
fight.
for them. Yeah. And the reason is straightforward. The Fed has plenty of room to cut rates once a slowdown tamps down inflation. But repeating the Arthur Burns era mistakes of easing prematurely before inflation was fully contained would be a historically embarrassing and economically detrimental policy error. That's exactly what happened and what caused the decade-long stagflation of the 1970s. And the Fed is very well aware of that, and it's safe to expect them to act accordingly.
Yeah, and this recent hawkish shift in policy expectations is entirely a product of this US Iran war. The spike in oil prices have reverberated throughout all asset classes, and treasury yields are going up,
Matt,
signaling worry.
I read the 7-year yield, uh, pretty close to the 10-year yield, but it went up almost 50 basis points in just the last few weeks. That's a lot.
A lot for treasuries. So it does mean treasuries are paying a higher interest rate if you own them. And that is typically a sign of worry for the market because they're seeing long-term growth expectations are now more worrying. So they're going to pay you more to hold on to these bonds. And this is a scenario now where this geopolitical tensions, you know, subside rapidly and oil prices correct, or there is a scenario where these tensions can subside rapidly. And there are a scenario where oil prices will correct from current levels and the labor market stays resilient in the coming quarter. But this is getting narrower and a narrower path. So that's why we're worried. That's why our signals went negative. And of course, this is a very fluid situation. We're in the early stages. As we said, maybe things get better. But the bigger risk is what if it gets worse and way faster than investors may realize? Now, I just want to do one caveat. Yes, we're saying we got out of the market. If you're out there on your own, be careful. Don't just take our advice and do it on your own. You need expert advice for doing stuff like this.
Great point.
We're just giving you what we're doing. So that's not a recommendation for you out there. We
Absolutely.
just got to clarify it. But to reiterate, that's why we're so defensive. That's why we're out of the market in our advance and protect actively managed portfolios, and their money is protected And I hope if you're listening, you have a lot more peace of mind right now knowing that.
Yeah, and a question for our listening audience. We were just talking about how our clients, we're sure have peace of mind right now with this volatility and losses. Do you have peace of mind right now with your investments? Wouldn't you say that this situation with the war is something that is not only becoming more concerning, but could get worse? And then wouldn't it be reasonable to shift your investment strategy, at least some, versus if this war wasn't happening at all? Does your advisor do that? Do they have the same exact investment strategy and allocations regardless of market conditions? Does that make sense to you? It certainly doesn't to us. So don't settle for that. You don't settle for cookie cutter portfolios. Your money is way too important for that. We are completely out of the market. We don't believe in riding market crashes all the way down, watching money dissipate. And if you want your money managed like that, if our investment philosophy resonates with you, please call our office and schedule a complimentary consultation. Our phone number is 847-780-2980, or you can reach us online at bnwealth.com. All right, don't go anywhere, because as soon as we come back from break, we're going to talk about enhanced Roth conversion opportunities this year in 2026.
Welcome back. Thank you for tuning in. This is Money Hour Radio, the show where we try and help you grow your money, pay less taxes, and have a beautiful retirement. I'm one of your hosts, Matt Nadeau, and I have with me my esteemed co-host, Ben Barzideh.
Hello, everyone.
And we're both founding partners. We're wealth managers at Barzideh and Nadeau Wealth Management. We're a comprehensive financial planning firm. We're independent. We're local, and we're located right in Barrington and serving the greater Chicagoland area. And of course, we value giving back and trying to make our community a better place. And that's why we've launched the charitable arm of our company, BN Giving. And it's a way for us to invest in your purpose with you.
Here's how it works. If you become one of our clients and you're a faithful tither or a giver to a charity, as long as it's a qualified 501c3, just let us know. Each year, we will match your donations up to 10% of the management fee that you pay us. So basically, we will tithe to your cause. And as our firm grows, so does the collective positive impact that we can have. It's such a unique concept. It's unique to our firm. We're very proud of it. And of course, if you're not a regular giver, that's fine. Most people are not. We'd still be happy and delighted to work with you. To explore joining our BN Giving movement by becoming a client, reach out to us online at bnwealth.com. Or, of course, you can call our office at 847-780-2980. All right, Matt, let's talk about some math, and let's talk about specifically Roth conversion opportunities this year.
You called me by my nerd name, Math, instead of Matt. Yeah. One of the things that we always do with our clients and with you, our listening audience, is we keep an eye on these different law changes that happen each year and how they impact you. And of course, one of the biggest impacts of the new law that went into effect last year, which was, the One Big Beautiful Bill Act, is what we view as an opportunity for some enhanced Roth conversions. So let's talk about the One Big Beautiful Bill Act and why we see these opportunities now for these higher Roth conversion opportunities. So first, this One Big Beautiful Bill lowered the tax brackets or kept the lower tax brackets and the bigger family benefits permanently. Initially, they were supposed to sunset. And that was one of the most significant outcomes of this bill. It permanently extended all the brackets that were first introduced back in the Tax Cuts and Job Act of 2017. So what does it mean? It just means lower brackets and bigger family benefits are here for you and your family to stay.
By the way, permanent is relative, right? Permanent until the next administration, right?
We joke. Permanent means you never know, but at least on the books, it's permanent.
In Washington, permanent doesn't mean the same thing as it does anywhere else. So here are the current brackets that are permanent as of right now. So you have a 10%, 12%, 22%, big jump between those two, 24%, then a big jump again to 32%, 35, and then 37. So those will remain in place indefinitely. And this is especially important for middle and upper middle class income earners. including many federal employees and retirees who often fall into the 22% or 24% marginal brackets. And that's because for joint filers, married filing joint, this covers income approximately between $100,000 a year to $400,000 a year. So there's a lot of people that fall into that. And for single filers, it's roughly half of that range. And family friendly provisions also saw improvements. So the child tax credit, which was made permanent, uh, actually got an increase for 2026. It's indexed to inflation now, and it is $2,200 this year. So that will help families keep pace with the cost of living and will put some extra deductions in their pockets.
Right. And then on top of all this, the almost double the standard deduction, which was a huge hallmark from that first Tax Cuts and Job Act, has been maintained. And really, most Americans will use that. So it simplifies tax filing for most Americans, reducing the need to itemize. And in fact, I think since the introduction of this provision, the percent of taxpayers who itemize dropped to under 10%. Now it may go up a little more this year because, the other thing they did is they added a much higher cutoff for the SALT deduction. It used to be $10,000 was the most you could take for state and real estate taxes, but now that's 40,000. But most people are still going to take the standard deduction. But between all of these deductions and itemizations, it's really, in our opinion, created some great opportunities, especially for retirees, to take advantage of these partial or what we call micro Roth conversions. So if done right over many years, you may be able to either completely convert or mostly convert a lot of your pre-tax IRA over to a tax-free Roth IRA, all while controlling and minimizing the ultimate tax hit you take. And we often see that in retirement, it's pretty easy for a couple who are in the 12% bracket. They still have a comfortable level of income as that bracket goes all the way up to $100,800 of taxable income after your deductions. So a lot of retirees fall in that 12% bracket.
Absolutely. So let's give you an example. Let's say Bob and Mary are over the age of 65 and they're both retired. For income, they rely on their Social Security benefits and a pension Bob has. And let's say combined, that's $97,500 a year of income. So a little bit under 100,000. But because they're over age 65 and the standard deduction is increased big time for seniors, due to the increases in some temporary provisions that add another $6,000 a year per person, or basically $12,000 a year for married couples, the standard deduction now this year in 2026 is a whopping $47,500. Basically, we don't pay any taxes, folks, up to the first $47,500 in our example right here for married couples over 65. So in our example, let's say they had 97,500 of income, and then with their deduction of 47,500, that means they will have about $50,000 of taxable income, putting them into the 12% bracket, which goes from $24,800 of income all the way up to $100,800 of taxable income. So a huge range there. So that means they can add about another $50,800, so almost $51,000 of taxable income and still stay in that bracket. So this is a golden opportunity to do about a $50,000 Roth conversion in our example. So let's say they do that. Bob and Mary perform this $50,000 a year conversion strategy, and let's say they do that every year for the next 5 years. So 50 times 5, they will have converted $250,000 of their pre-tax IRA to a Roth IRA over the course of that time while controlling and minimizing the tax hit. Then later in retirement, not only will this strategy help keep their taxable income low, since they won't have any forced required minimum distributions from a Roth IRA, and then furthermore, any income they want to take out of their Roth IRA in retirement is completely tax-free anyway, so it won't bump up their adjusted gross income. So who doesn't love tax-free retirement, right?
Some of my favorite words, tax-free.
Tax-free
Love
income.
it. Yeah. So this, I mean, we believe it's a very powerful concept, and if done right, it can be a huge benefit for you and even your heirs because they would inherit these Roths tax-free. It's fantastic. The key thing is it has to be done right, because if you take too much money and convert to Roths, you may put you into higher brackets. You may trigger some other issues that you're not thinking of. Some of them are, for example, like your Social Security tax can be negatively impacted by adding more income. Social Security looks at something called provisional income, and every dollar you add from a Roth conversion adds to that income. And in some cases, we see where people are in the 12% bracket, but a Roth conversion's actually costing them like 25 cents on the dollar. So very careful that you don't do that unnecessarily. Medicare premiums could be impacted. There's IRMAA, which is if you hit above a certain adjusted gross income level, you can have your Medicare premiums go higher. So you really want to be careful before you do this. And one thing that a lot of people miss out on is if they have some kind of capital gains during the year, maybe own a mutual fund that pays out a capital gain distribution. If you get these surprise capital gains, that may wipe away some of the strategy if you don't calculate that in there. So definitely things to be careful of when you're doing this. And that's why you need a professional with like anytime you're doing financial planning, investing, taxes, estate planning, you need to work with a qualified professional who understands these concepts and will tailor them to your situation. And usually we see us as a good financial planner acts as the quarterback in this situation and helps coordinate a lot of these ideas with your other professionals.
No doubt. And it's so important to make sure that you're looking at all the variables that go into that calculation. So we're aware of these. We have software, we have different reports we can run that really helps us identify what may make sense or not. And if you're just doing it on your own, you could definitely be causing yourselves some problems if you do it wrong. So if you are in need of a good, knowledgeable financial planner, someone who puts your interests first, we would be honored if you gave us an opportunity to talk with you. If our investment and financial philosophy resonates with you, then please reach out to us and schedule a complimentary consultation. We'll go over your current financial situation and your goal. We can provide a financial checkup where we analyze your entire financial picture. If we can help you, that's great. If we can't, that's fine. You know, we can't help everyone. We'll let you know. But to explore becoming a client, please reach out to us online at bnwealth.com or call our office at 847-780-2980. All right, we're out of time. God bless you guys. We'll see you next week.
Take care, everyone.